If you're too busy to stay up to date on financial markets and investing strategies, one of the best ways to boost your returns with minimal effort is using a Robo investing platform. Whether your goal is to buy a new car soon, build a multi-million-dollar nest egg for retirement, or anything in between, I'll review what a Robo platform is and 8 benefits of using one. Welcome back, everyone. Thanks for joining me. I'm Laura Adams, an author, financial spokesperson, speaker, founder of the Money Stack newsletter, and host of the Money Girl podcast with 43 million downloads. Be sure to subscribe to the show if you haven't already. That's the best way to ensure you never miss an episode. We're doing 2 shows now, Wednesdays and Fridays. Finance Friday is a Q&A format, and if you have a question you'd like me to cover on a Friday Q&A show, I would love to feature it. Just leave it on our voicemail line at 302-364-0308. You can also send me an email using my contact page at lauradadams.com. Understanding 8 primary benefits of robo investing platforms can really help you take the right amount of risk, cut your fees, and meet your short and long-term financial goals. So we're going to go through 8 of them. The first benefit is that you get SIPC protection. Robo investing platforms offer features and technology that you will not find with some traditional financial firms, and I'll review many of those features here. However, one benefit that is the same is getting protection from the Securities Investor Protection Corporation, or SIPC, for your Robo accounts. The SIPC protects customers of SIPC member firms if the company fails and they go out of business and they can't repay their investments like stocks, bonds, mutual funds, or even cash that you have purchased with that account. Therefore, if your Robo platform goes out of business, the SIPC helps you recover up to $500,000 of investments, and that includes up to $250,000 of lost cash. However, the SIPC never covers losses due to market volatility or just investments declining in value. Also note that it's different from FDIC, which stands for Federal Deposit Insurance Corporation Insurance. That's what participating banks offer. So don't confuse the SIPC with FDIC insurance, which is very different. It covers up to $250,000 of your deposits per banking institution per account ownership category, such as individual or joint account ownership. Okay, the second benefit of a Robo platform is that you have a fiduciary relationship. So this is another reason Robo investing platforms are just as safe as many investing companies. They are regulated by the Securities and Exchange Commission, or SEC, as registered fiduciaries. A fiduciary is required by law to act in your best interest. And I want to note that many online brokerages are not fiduciaries. They operate as just a transaction-based stock broker and are not required to act in your best interest. So always be sure you understand, what is that relationship you have with the company? Are they just a stockbroker, or are they going to work with you as a fiduciary? The third benefit is that you select your account type. Most robo investing platforms offer various account types. It could be high-yield savings, taxable brokerages, and tax-advantaged retirement accounts like IRAs. I have all those accounts with Betterment, which has been my robo-advisor for decades. And another platform to check out, especially if you're a beginner, is Acorns. And I'll have links to those in the description for the show. For instance, my savings are for emergencies and any planned short-term purchases. My brokerage is for medium-term goals. These are expenses that I'm planning to have more than about 3 years into the future. And my IRAs are building wealth for the long term, so I have plenty of income in retirement. Some robo platforms may also offer retirement plans for the self-employed, such as a solo 401k or a SEP IRA. That's what I have, a SEP IRA with my Betterment account. Or they may offer regular 401ks, which you could provide to employees if you run a small business. Benefit number 4 is you choose optimized combinations of funds. Robo investing is an automated way to build wealth using a portfolio of funds. So the platforms allow you to choose your level of risk based on an initial intake questionnaire that considers your age, your savings, and your goals. Then they choose various index or exchange-traded funds with the underlying assets that match your risk profile. But you can always increase or decrease your desired level of risk as needed as things change in your life. Robo platforms exist to prevent you from losing money by picking individual stocks, which honestly is more of a gamble than an investment for the average person. Investing in funds means you're buying hundreds or even thousands of underlying securities like stocks, bonds, and real estate. In other words, you purchase the returns of the market instead of just one company, such as just buying Google or Disney stock, and that cuts your risk. Benefit number 5, you get broad market diversification. The optimized combinations of funds that are used by robo platforms represent different asset classes. They might include domestic or international equities, bonds, real estate, or an entire index, such as the S&P 500 or the Wilshire 5000. While swaths of the market can undoubtedly decline, owning investment funds over a long period reduces your risk. For example, from 1973 to 2022, the United States stock market returned an average of 11.7% annually. So if you invested $10,000 in a total market index fund back in 1973 and you just left it untouched, today, you would have over $2.5 million. Now, let's assume a more moderate average annual return of 7%. A $10,000 investment today will grow to about $76,000 if left alone for 30 years. But let's say you invest $10,000 annually, or about $833 a month, with the same 7% return, you'll have more than $1 million after 30 years. Benefit number 6, you pay relatively low fees. In addition to making you a diversified investor, robo platforms aim to cut your expenses. They charge fees that are much lower than many human financial advisors. That's because they use technology like algorithms to deliver their service at a lower cost, and they offer low-cost mutual funds and ETFs, exchange-traded funds. For example, a typical advisor might charge about 1 to 2% of a portfolio value that they manage annually. And if the market allows you to earn 7% and an advisor takes 2% off the top, well, you only make 5%. And you still pay an advisory fee even in years when the market underperforms. The larger your portfolio, the smaller the management fee should be, but it still adds up. Robo platforms may charge less than 0.35% annually, which is a bargain. For instance, if you have $100,000, your fee could be about $350 a year or $29 a month. You also pay fees for the funds in your portfolio. Those are known as an expense ratio. They automatically get deducted from your balance, so many people mistakenly believe that they don't pay any investing fees. Remember that no-fee investing does not exist. You should expect to pay reasonable costs even when you have a small portfolio. However, wise investors should do everything possible to minimize fees, especially during the accumulation phase of life, where you may not need specialized advice. Now, I'm not saying that talented advisors should not be fairly compensated for their guidance and investment management services. They should be. But you'll likely only need ongoing financial management if you have a large portfolio, or let's say you are approaching or already in retirement. Benefit number 7, you get automatic asset rebalancing. Robo platforms routinely monitor the asset classes you own and rebalance them back to your intended proportion and risk tolerance. So what happens is they sell the fast-growing fund shares and buy slower-growing ones to keep the original shape of your portfolio. For example, if the stock market rises, your portfolio could become overweight with stocks, which are inherently riskier than most other asset classes. So the solution is to sell shares of stock funds and purchase other asset classes, such as funds with bonds or cash, to ensure you're not vulnerable to more investment risk than you want. So that makes robo-investing an excellent way to stick to a plan in mathematical detail. An algorithm won't sell shares in a panic if prices go down or buy shares rising fast out of greed. It keeps you from trying to beat the market or doing something undisciplined with your money. Number 8, you get the benefit of tax loss harvesting. Many robo-platforms offer automated services to reduce your income taxes, and this is known as tax loss harvesting. It's a strategy provided by most traditional investing companies, but it can be manual, time-intensive, and therefore expensive compared to robo-services. Tax loss harvesting is when you sell some investments as a capital loss to offset capital gains or other taxable income in your portfolio. It gives a typical investor who uses it a $3,000 deduction against their ordinary income tax. For example, let's say you have a 20% average tax rate. A $3,000 deduction would save you $600 annually. That's likely more than enough to cover the annual fees a typical robo platform charges. Tax loss harvesting legally lowers your net taxable income if certain conditions are met and you use a taxable brokerage account. It's not a strategy for retirement accounts because your taxes on gains in those accounts are either deferred or tax-free when you make withdrawals. Because robo platforms are software-based, they can make complicated tax loss harvesting calculations and required trades at scale and for a low cost to customers. Your responsibility is just to file the paperwork the platform sends you. It could be a Form 1099-B to report capital gains and losses and a 1099-DIV to report dividends with your tax return. So whether you're a new or an experienced investor, I hope the show has given you a little bit of insight into how robo platforms work and all the benefits you get when you're a customer of one. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. It's audio engineered by Steve Rickyberg. Our director of podcast is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. Our marketing and publicity associate is Davina Tomlin. And our marketing assistant is Cameron Lacey.